We are in for a real treat today, and I want to welcome everyone to the 2012 IBM Lecture. For those of you who don't know me, I'm Dr. Barney Forsyth, and I'm the president of Westminster College. The IBM Lecture was established here at Westminster College by the IBM Corporation in 1980 to bring leaders and scholars from the world of business and finance and economics to campus to share their views and their expertise. In addition to IBM, I want to say a special thanks to the Callaway Bank for coming forward as a sponsor of this year's lecture. And let's give the representatives of the Callaway Bank, Mr. Bruce Harris and his team, an applause and say thank you. This is a perfect example of town and gown partnership here in Fulton and in Callaway County. Today's lecture could not be any more important or relevant. We saw the demise of the theory that American banks could be too big to fail with the financial crisis of 2008 and 2009. And ever since that time, the condition of America's economy, and in turn the world's economy, has been in the headlines. In the face of all these events, I'm sure that you are just as interested as I am to hear what our IBM lecturer for today, Dr. Thomas Hoenig, has to say about the future of banking. Dr. Hoenig certainly brings a world of experience and expertise to the topic. He earned a PhD in economics before he took his first job at the Kansas City Federal Reserve Bank in 1973, and he worked his way up the bank hierarchy to become the president of the bank, a position he held for 10 years. On April 16th of this year, President Obama appointed him to the board of directors of the Federal Deposit Insurance Corporation, where he will serve for the next 6 years. As you know, the FDIC is an independent agency of the federal government that insures individual bank accounts for at least $250,000, monitors and addresses risks to deposit insurance funds, and limits the effect a failing bank or thrift institution has on the economy. Obviously, they're doing a good job, because since the FDIC insurance began, no depositor has lost a cent of insured funds because of a bank failure. So it is quite an honor to have an individual in such a prestigious position here with us today as this year's IBM lecturer. Please join me in giving a warm Westminster and Fulton welcome to Dr. and Director Thomas Hoenig.
Well, first of all, thank you. Thank you for the invitation. Thank you for the very warm welcome. I'm impressed that there is standing room only, because I am an economist after all, and I've been often told that that the definition of an economist is an accountant without a sense of humor, so I'm really worried about this. I also want to tell you how honored I am, because I know the history of Westminster. I know you have much to be proud of, not just because of Winston Churchill, but because of the many alums who have left here and gone on to do really outstanding things, not only in the region, but in the world itself. And so it's an honor for me to be asked to speak to the future leaders of the world. In fact, I also am honored because I have such a great respect and love for liberal arts education. I'm a liberal arts educated myself. I went to a small liberal arts college in Atchison, Kansas, enjoyed it enormously, and have always felt that I gained more than anyone at a large university can hope to achieve. So it is a great pleasure to be amongst others who have a love for liberal arts education. I'm going to talk today for a few minutes, and then I'm going to open it up for questions from the audience. And if I were giving a title to my remarks tonight, it would be choice under uncertainty, and the comfort of crowds. And I'm going to weave this story, if you will, back to why I think it's so important to have a broad base of education, because of the choices that you have to make as citizens, perhaps in a policy position someday, and how you go about thinking about it, how you choose to stand with or stand alone will become incredibly important to you and to whatever group you represent or to the country, depending on your position. Let me first of all describe to you the uncertainty of choice, especially in a policy role as I have been involved over the last 20 years. And it starts with monetary policy. It affects financial stability and the choices we have as a deposit insurer in our instance, or as the Federal Reserve in a prior life, of choices that will affect both the immediate but the long term. And those long term are the more difficult ones to sort out, and why it takes a great deal of knowledge and courage to step up to those choices. In monetary policy, it seems like a simple thing. If you lower interest rates, the economy will do better. If you raise interest rates, the economy will do less well. But of course, that's not how it really works through. It's very clear that when the economy slows, we tend to lower interest rates. And for a time, a temporary period, a short period of time perhaps, the economy can in fact be stimulated, can grow. People can be sure they have a job. All the things that you want from that kind of policy. But if you continue it too long, or you continue it too vigorously, you begin to misallocate resources. That is, you begin to encourage speculative activities, because how can you pass up a deal like that because interest rates are so low? You begin to increase the pressure on prices because there's so much money available that people begin to chase goods. And in the end, you can end up with a society that is devastated by the effects of a well-intentioned policy that was designed only to stimulate the economy. And if you look in history, and you go to Europe, and you wonder today why the Germans are so reticent to go along with some of the policies, you look at their history, it was one in where a well-intentioned head of a central bank put enormous amounts of money in play to help the economy and destroyed a society. So it's not a simple choice, is it? The immediate against the long term and the consequences of those policy choices. On the other hand, if you are a strong advocate for sound money and you keep interest rates high for an extended period of time, higher than what they need to be in that economic set of circumstances, you can increase unemployment. You can lead to a deflationary environment and destroy a society that way. So not easy, not clear. And therefore, the choice of policy becomes not simple, not obvious. It becomes difficult, and the trade-offs become hard to sort out. And I'll tell you, in 2001 and 2002, that's exactly what was going on, and the choices made, I think, contributed importantly to the crisis of 2007 and 2008. Because what was going on at that period after the 9/11 that took place, after a recession, the Federal Reserve, the monetary authority, chose to keep interest rates extremely low for, at that time, a considerable period of time. And so it put these very, very attractive rates out there. Money was plentiful, and everyone should have a home. And so lending standards were lowered. Money continued to be pumped in. Houses prices boomed until they didn't. And then we had a crash. And the choice was a bad choice in hindsight. But of course, that's always known best in hindsight, isn't it? Never in front of us. And so now that same open market committee is in the throes of debate within itself, and I'm not a part of it any longer, but they're still making those choices, because right now the question is, how can you keep interest rates zero without destroying the economy in the long run? Or are you so confident that you can withdraw the excess stimulus in a way that will save the economy from any negative effects or consequences in the long run? And the hope is that they'll be able to do that in a timely fashion. The track record makes that less clear. So those are the circumstances of the decision-making process that are in play now for those policymakers. So what about the comfort of crowds? On that committee, besides the chairman, whose name is Ben Bernanke, are 11 other voters. And the pressure in that environment is to support the chairman, even though you have a vote. And of course, if you do, and something goes wrong, you won't be identified because you're one of the crowd, and only the chairman will be identified. But if you step out and say, no, I think that's wrong, I'm voting no, then you stand alone. And you stand at risk against the chairman, and therefore are also thought as not being, in many cases, a consensus player, and the pressure builds. Now, whether you're wrong or not, you don't know. You don't know. All you have is what you know from your education, what you know from choices, what you know from history, and yet you're taking a position contrary to the majority, that is, to the crowd. That's extremely important as you think about decisions that are going to be made in the future. So set that aside for a second. Let's talk about banking and crises. A crisis is something that no one expects, no one is prepared for, and no one can handle well, almost by definition. Not as well as anyone would like. So we had a crisis in 2008 in which asset values began to plunge, people were forced out of work, the markets were in disarray, and what do? Well, here the majority felt you have to put in liquidity, you have to put in lots of money. I happen to agree with that, so that you staunch the immediate crisis. But when you're doing that, that's the easy choice. The hard choice is how long to do it, and when to pull it back, and what incentives are you building for the banking industry that you then have to try and unwind later, because it will change behavior in the economy and change outcomes for you in the next 10 years beyond what you might be able to imagine at the moment. And so that process is going on today, because the emergency process continues, although the economy is on a very slow recovery. But here's the choice. The choice is we leave it in place because it's safe to do that, because we know that that at least will put money into the economy, and we'll worry about the consequences, whether it's a misallocation of resources, whether it's inflation that we have to fight later because right now it's not very significant. And what will that do to jobs in the future? What will that do to wealth in the future? And who will pick up the tab in the future? And so the choice right now has been made to continue it. The other choice was to pull it back, to say, no, it can't be zero forever, it's misallocating, we'll have the economy adjust, and what you do then is risk a recession sooner than you might otherwise have had it. However, you don't know that for sure. It's uncertain. It's only your choices made on experience, on looking at the numbers, on how you've been educated, and what you think the future may evolve to. There is no certainty in the choice. So the comfort of crowd is to say, well, this is where the majority is right now. I will hide in the crowd, or I will stand alone and take a different position if based on your experience, you think there's a better or a different way that has to be chosen. So again, the difficulty and the uncertainty of choice, the comfort of crowds. And that's what we face today. The third area where we see that in policy today is in fiscal policy. We have engaged, because of this crisis and the fear of adverse effects on the economy from the crisis, we've engaged in this country in a stimulus program that is really second to none in our history. We have put enormous amounts of spending into the economy. We have borrowed over $1 trillion a year net deficit. That is, we've borrowed more than we've taken in of over $1 trillion over the last 4 years. And the reasons are well-intentioned. The reasons are to keep people from going and losing their jobs or being out of work, or if they are out of work, to try and bring them back into the workforce. The intentions are well made. But what are the consequences? The consequences are that we have a debt now that is growing to 100% of our national income, which is unsustainable for an economy. Which means that when the time comes, there'll be even more pressure on the central bank to print money to accommodate the debt, as is happening in Europe today as well. So the short-term goal is to make sure the economy remains strong, and you're trading that short-term goal against the risk of long-term consequences that will affect your generation more than it will affect my generation. Hopefully, those who are engaged in this fiscal stimulus are right, but you don't know. You're uncertain. So the comfort of crowd is to go with this. To stand alone is to say, no, here's a different way. And if you were to be right, you don't get heard. If you're wrong, it will be noted, believe me. So that's the process of, if you will, the uncertainty of choice and the comfort of crowds. We know from the research that's been done around the world, actually, that in a committee, vigorous debate is by far the best in terms of leading to better outcomes. But in the comfort of crowds, the debate usually gets stymied. And those are the choices, it makes the choices that much more difficult. Now, I tell you that, and then I'll come back to banking here in just a second. I tell you that because if you have, it is part of my issue with specialized education. If you can believe, I can circle this back to education. Because specialized education focuses the individual on a particular topic rather than on a broad base. And it takes a broad base of knowledge to sort out the various forces in the uncertainty of choice going forward. In the policy world that I've dealt with, we've had what I call geniuses in economics working on this. I mean, literally geniuses. But the thing that they lack, in my opinion, is judgment, wisdom, a breadth of knowledge beyond their narrow focus to where they can see and are able to see and have had training in seeing the longer-term consequences of the immediate decision. So there we are. And now I'm going to talk about the future of banking for just a few minutes. The future of banking now is coming out of a crisis. And out of that crisis has been enormous, enormous increases in regulation. A 2,300-page piece of legislation called Dodd-Frank that I would challenge anyone in this room to read. It is very, very difficult reading. That has led to literally tens of thousands of regulations that have to be dealt with, including those that are upon the FDIC. As a director of the FDIC, I have several responsibilities, and two of those, besides the insurance fund, making sure it's sound, is to look at the largest institutions in this country and see how they could be brought into bankruptcy. Something we were unsuccessful at in the last crisis, so we bailed them out. And second of all, if we can't put them into bankruptcy, how you then bail them out in a way that doesn't benefit the ownership of those institutions over the broad public, who the taxpayer will be picking up the bill. I think that's one of the most difficult things that we have at the FDIC and that the banking industry has to face going forward. Because out of this crisis has come an enormous resentment of the financial system by the middle class of America, and rightfully so. Because the middle class picked up the tax burden of this as they were bailed out. And these institutions and some of the CEOs, even when they were asked to leave the institution, left wealthier than any of us would hope to be in our lifetime. And that was the punishment for failure. The other element of it, some of them weren't asked to leave. There were stockholders who had invested who didn't lose, even though you paid the bill on that. So there's an enormous resentment, and that's why the burden of Dodd-Frank is so heavy. It was designed to make sure this didn't happen again in a regulatory context rather than a market context. That is, succeed and failure on your own merit. It's now, you will be saved, but here's the price you're going to pay for it in terms of regulation. And of course, that hurts the market. Excuse me. So what it means for the future of banking, I'm concerned. I'm concerned for this part of the country. I'm concerned for community banks in this part of the country. And here's why. Because of this ability to bail out, and because they are too big to fail, that is, they're so large that the failure of anyone will disrupt the economy so greatly that we can't allow them to fail. That's why it's taken on, because people don't want you out of work. They have to bail these institutions out so it doesn't have a negative impact. That gives them an enormous advantage. When you can't fail, where are you going to put your money? You're going to put them with the people who can't fail. And therefore, you see this consolidation taking place in the industry. When I started in banking in 1973, there were over 15,000 commercial banks operating in the United States. Today, there are less than half of that, about 7,000. When I started in banking, the largest 10 institutions had about 25% of control of the financial assets under management in the United States. Today, that's over 60%. When you see the regulatory burden of the laws that are placed in there, it disproportionately hurts the community bank relative to the largest bank because it's a fixed cost. And for those of you who are in accounting and economics, you know when you put a fixed cost, the only way you can get the unit cost down is make the assets bigger, have more assets. That means you have to consolidate. So my concern is that as we drive to protect the largest, we will drive out the smallest. And that leads to my final point, that unless this is changed, and I think it can be, what you have then in the success of this country over its 200 years has been that its industrial firms have had financial institutions that mirrored them, some large all the way down to small. And we're changing the financial institution side from having a very few large institutions and many fewer substantive smaller institutions down. And when you do that, the financing for the entrepreneur, for the family business, for the community business is handicapped and goes away. Therefore, you have a less robust economic system, and over a long time, over a generation or 2 generations, a less successful economy. So that's why I have, in my debates, and I've had many in the Congress and with the other agencies, have very substantially said, let's change that model back. Not eliminate large institutions. They're essential for our economy. But to confine their activities to those activities for which they were intended. That is the payment system that you all rely on, whether you use a debit card, or a few of you may still write checks, and the lending process that comes out of that, which is known as commercial banking, and not be able to engage in high-risk broker-dealer derivatives activity that got these institutions, these large institutions, in so much trouble. And if we do that, we will have a more competitive industry. It won't change overnight. It won't become what it was when I started banking, but it will be less inclined to become only 4 banks in the United States. And therefore, we'd have a more successful model for this country in the long term. So that's what we're working on, as we also at the FDIC work on how we resolve these largest institutions in the future. We also think it's important to think how should we structure these institutions. And just so you get the point, I will tell you this for a fact. If you are in the market, if you're in the market of speculating, if you go into a market and you think the price is going down, so you buy, you sell forward, for those of you who are in the commodities market or know something about it, if you make a mistake and the price goes against you, you will be required to bring more money forward or they'll wipe you out in an instant, believe me. If you're a commercial bank that has insurance with it, deposit insurance, and you're thought to be too big to fail, if the market goes against you, you can go into the market and get all the funds you need to cover the call. You have a huge advantage over anyone else in the market. So guess who's going to win that game every single time? It's the person with the advantage. And unless we change that model, there will, in 25 years or 30 years, be 4 institutions operating in this country, and we'll all be subject to their rules. And I think that's a devastating outcome for a country as successful as the United States. So I'm going to stop with that, on that rather positive note, incite you to make change, to understand it, to study it, to take that liberal arts education and make a difference with it as we go forward, because your generation is a generation that will be most effective as we go forward. So let me stop there and see if anyone wants to challenge me. I'm very happy to have that, or if you have any questions. It's a big crowd, I know. Yes. Slightly, yes. Well, the question was if, now you're talking about the government spending into try and right. Right. Well, they have help doing that. Spain is leading the way, but they've had a lot of help from Greece, from Portugal, from Ireland, from Italy, from France. But here's the thing. Yes, I am concerned because the debate that did not take place because of the rush in the stimulus was the purpose of the funds. So if you put it out there and you say spend it anyway, you pretty much get it spent anyway. And the issue that was behind the scenes debated was, all right, what does government usually spend in the first place? Infrastructure, investments such as that. And so what you do is you pull those forward so that then you have those, so that when you then have a recovery, you can then decrease those without all these other new programs that you have to unwind, and very painful to unwind at that point, and we didn't do that. So now you have these enormous spending programs in place, and the pullback of those in and of themselves can slow the economy down, because it's, now whether you're getting $1 worth of output for the $1 worth of input will be another part of the debate. But behind that, of course, is the debt, is the borrowing that went on to do that. And the borrowing has been enormous over the last 4 to 5 years. A net $1 trillion increase in debt from 40% of GDP to close to 90% of GDP. It is not sustainable, and we all know that. So if you don't change that model going forward, what you do is you will, in fact, cause your economy to stymie because your cost of capital will go up, because that money has to be borrowed or printed. And right now you can print it without having interest rates go up, but at some point that will stop, because once people begin to see the inflation, then the interest rates will be adjusted, and we will see a major impact on the economy. In the short term, you have a major issue, because right now, at the end of this year, if there isn't some agreement, we go into sequester, which means major cuts and major tax increases at the same time. And most economists know that that means there will be a recession. Now, whether it's a deep recession is debatable, but everyone knows there will be some kind of a pullback. And so they're worried about that. And when we were talking earlier, my point to earlier was, if you define for the American people what you're going to do, and it makes sense, the American people understand that. They will buy into that, and you will change the dynamics of the economy. And what you need to do is say, here's the 10-year and here's the 25-year. The 10-year is certain, the 25-year is a direction in terms of reduced spending, including Medicare, because you can't afford to pay my Medicare. So you have to include that in there. But also other kinds of spending. And here we're going to broaden the tax base, because the most middle class are suspicious that the tax burden is not fair in the sense of what they think of as progressive income tax or constant income tax. But they don't trust the outcome. So what you have to do is broaden the base, and if they do that in a way that is, both parties agree, whoever the administration is agrees, then the psychology of the market will turn around almost overnight, and you'll see a growth. I think you begin to see growth in the economy. If they choose not to do that, then you'll continue to add deficits until it implodes on itself, and we have a worse recession than one we just experienced. So the choices are there. The choice under uncertainty is there, but the debate is partisan. It's not about the issues. It's about control. It's about winning and losing. And you could see that in the reception that Bowles-Simpson, which was a bipartisan proposal that came out over a year ago and was pretty much dropped as soon as it was introduced because of the partisanship rather than common goal for the country. And that's a big issue for us. So, yes? I'm not seem to be saying it. I am saying it. Oh no, it's straightforward. If you look at the balance sheets of the largest institutions, I can cut out their trading activity, their market making activity, their broker-dealer activity pretty straightforwardly. No matter what they say, I can do it. I've looked at their balance sheets, so many others. Once you can do that, then what you do is you set those over here, and you allow them to continue with their commercial banking, their payment system, trust activities, and some underwriting activities, as was allowed under Glass-Steagall. So you can do it, and what you do is there's no takings clause, because what you value the asset just like a merger and acquisition, only it's a spinoff. You value the assets, you then spin it off to the same shareholders, but you have different corporations. Now, that means their stock trades, it'll eventually change out quite a bit, and you have a different banking structure. Now, what will be one of the consequences? You know, right now in the area of investment banking, you cannot compete successfully at size because of the safety net advantage that the largest banks have over an independent broker-dealer, because there's no insurance fund there. So if they go broke, everyone knows. If you watched MF Global, if you watched Peregrine, they didn't have any insurance fund, so people took a hit. And everyone knows that. So you can't compete against the largest. So by taking these assets, spinning them off into a separate corporation, as we did after the Great Depression, you will eliminate that advantage. And that's why the safety net was originally put there, to protect the payment system and the lending process that was tied to that. It wasn't to protect the investment banking activity of speculating in the commodities market, the copper market, the derivatives market. That's all been distorted at tremendous cost. They say that they paid all the TARP back, but who's paid for the trillions of dollars of lost wealth that went on, and for the 10% unemployment and now the 8% unemployment? Those are the real costs. And so we need to change that structure, or we're doomed to repeat the history. So, yes. The media is like any other profession. There's some really good writers, and there's some really bad writers. The good writers get it; they get it pretty well. They get the story out, but they also know the facts. They hunt down the facts. They're willing to ask the right questions, and those I have a lot of respect for them. Now, some of the movies, they come in, if they come in with a bias, you're going to get a bias. There's no question about it. It doesn't mean that all of it's inaccurate. It means that the facts are, you get all the facts on one side, but you don't get the facts on the other. It's not that it's incorrect, it's that it's one-sided correct, and that you have to watch for. And my theory is, and I won't name newspapers, but I want one point of view, I read this newspaper. I want the other point of view, I read that newspaper, and then I can make a judgment somewhere in the middle, and I'm usually right. That's the way it works. Yes? You mean they were lending money when they're... Well, I don't think that any bank... if they knew the recession was going to hit, I can tell you they would have done a lot of things differently. They didn't know the recession. Look, I got to tell you, the madness of crowds exists. I mean, you get in the moment, and you're making. I have been in banks where you look at their concentration in commercial real estate or in mortgages, and you say, you got a heavy concentration there. If rates do this, you're going to be in. No. Look at this portfolio. It's always paid. We're good. So you don't get people saying, yeah, we're going to be in trouble, so I'm going to lend. You get people saying, we'll get through this. We're different, and they lend. It's that inability to see the downside of their choice that gets them in trouble. Now, in Bank of America's case, actually, their issues were in their acquisitions in the recession. They acquired IndyMac and they acquired Merrill Lynch, who were both under enormous, well, I mean, IndyMac was just completely rotten to the core is the only way to describe it. And so they took those on, and that hurt them very seriously. So I don't know and I don't think they intended for that outcome, I can assure you of that, but that's the outcome they got. And that's why, it comes back to my point, choice under uncertainty. If you're going to do something like that, even if you think the world is perfectly great, it's going to go forever, if you don't do due diligence, you don't look at what it is you're going to acquire, you are going to be in trouble. And there's no escaping that. Because the uncertainty of choice, even when you go in and do that, you still can't be sure. But if you don't at least do that, then you know you're going to be in trouble. You've got to have information. Thank you. The question is, was the creation of the Consumer Protection Bureau necessary as a result of this? I don't know the answer to that in the sense of, I think, sure, you could have done it elsewhere. I mean, when they were talking about it, I said the problem that you have with that is you never get away from the loan's quality related to the compliance to the consumer reg, because if you don't write it correctly, your loan's in trouble anyway. So you always have that issue. Were there abuses? You bet there were abuses. And it was many, many abuses in the credit card side. And that's a big part of why I think that institution was created, to address that particular side. There were many abuses in the mortgage lending side, but that wasn't in the commercial banks directly. That was in a kind of I'll call it cowboy industry at the time. The small mortgage broker who was packaging these and sent them to a underwriter that had a goal of volume rather than quality. So those are the things that went on there. Could you have done it without it? Of course. I mean, you could have, it's like anything. You could have required that the Federal Reserve, who was writing the rules, write those rules much more strongly, be much more accountable to the Congress, but the Congress chose not to do that. And so we have it. And now they have a duty, an obligation to enforce it, and it's a tough area because I've seen. I mean, I know what fair lending is. I know what these rules are, and I know how a well-intentioned effort can get into the weeds and be very, very costly. But at the same time, there was no excuse for some of the abuses that went on. So, find the balance is always the issue, and we tend to add regs rather than deal with the problem, and that's my point. Rather than add 2,300 pages of Dodd-Frank, what we should have done is break these institutions out, make commercial banks, make investment banks, investment banks. And I will tell you, that law was introduced before World War II, the dividing up of the commercial banking and investment banking. Until 1999, when that was ended, and they moved them together, the United States was the most successful capital markets in the world, the most innovative capital markets in the world, the most obliging capital markets in the world in terms of capital accumulation and investment. It was after they merged the two that the problems began. And it goes back to Adam Smith. Specialization is a good thing. Specialization can be a very profitable thing. It's when you merge things that don't have real relationships that you get into trouble, and we got into trouble. The conflicts were overwhelming. So, yes, way up here.
You're way too sensible for a government employee. I have two comments.
Sure.
One is on the Fed Open Market Committee, and when you think about your topic of safety and crowd, where were you in that environment? How did that work out for you? And secondly, on the tag program, we've got about 90 days until it's set to expire. Is the flavor today that it's going to be extended or not? How do you see that affecting community banks?
Well, on the first one, I voted against the policies of easing in every meeting in 2010, my last vote series. So I felt strongly that it would set expectations around the need for low interest rates that would then affect the allocation of resources in a way that would feel very good for about 4 years or 5 years and then begin to erode. And I still feel that way because I'm seeing what's happening to asset values, whether it's farmland, leveraged debt, junk bonds, whatever it is, the asset values are of concern, especially when you have to reverse this policy. And so I felt strongly that way. And now, how did it work out for me? Well, I'm standing alive. It was not pleasant, but it was it's what you do. On TAG, I understand the issues around TAG, and the FDIC has taken, because it's a legislative matter, and the FDIC has taken a neutral position. The TAG is for deposits that don't pay any interest and so forth. It's a kind of a business account sort of thing. And I've talked, let me put it this way, I've talked to a lot of bankers about it, and it's about 50-50. 50% say, I don't want it, I don't need it. 50% saying, the large banks have an advantage, I'll lose my customer. I don't know for sure how that'll work out. I do know that it's not a free good. We know that the amount of reserves that the FDIC has to hold goes up pretty dramatically. And guess what? Someone's got to pay for that. And so I want to be very thoughtful about it. And that's another point that I make with people. That's an issue. It's a legitimate issue. if you were to break up these institutions and you made these large institutions much more likely to be put into receivership if they fail and not be bailed out, then that levels that competitive playing field with the community bank. And that's the best outcome that I can see. Because insurance is an incentive. It's a subsidy that has a cost to it, an allocative cost, an advantage cost, and so forth. And so we need to keep that confined as much as possible around those large institutions. And that's why I'm so adamant that they have to be broken up, not by size. I'm not saying cut them in 4, by line of business. Get that risk stuff out of there. It's absolutely essential for a successful economy in a market economy. If you put it inside the banks, you've got a public utility economy and really bad outcomes. So, any others? Yeah, way back here.
Given today's interest rate environment, what are your thoughts on the next 5 or 10 years? Rate continues to increase, what people may do, particularly in our smaller communities, when they hope to upgrade and move into a bigger home at a bigger mortgage instead of 2% rate shock.
It's a very important question. Here's the issue, though. The issue is not about the interest rate. The issue is about the dynamics of the economy. If the economy begins to actually heal and improve to where you have a growth rate that's closer to 4% than 2%, which I think is doable given the resources, then you have jobs being created around that. And you can't just create them. I mean, we say create, but small businesses have to have the ability to expand, have to have demand and so forth. But the fact of the matter is, it's not low interest rates that makes a person able to buy a home. I mean, we still have a housing market problem with basically a mortgage you can get today at 3%. That's not keeping people from buying a home. If you have a dynamic economic system and people do it, have a job and have confidence in the future, mortgages at 6% used to be a bargain. It never kept anyone from buying a house, ever. Even 8% people could buy homes if they had a positive outlook for the economy and they had a job. So that's my point. When you have it 0, you've set the expectation around that 0, and people hold back because they don't know what it means. It's abnormal. So what am I going to do? I'm going to hold back. Businesses are holding back. They don't know what's going to happen. And so we need to change that dynamic, and 0 interest rates won't do it. Because look, when those interest rates go up, even 25, the first move up, it's going to change all the expectations in the system, and I don't know which way. Some will say, well, the economy must be getting better, so that's a good thing. Others will say, oh my God, we're going to have a big increase in interest rates, so they'll pull back. You don't know. The uncertainty of the decision will be a very difficult process to get through for the Open Market Committee. So, yes?
Thank you for your service.
Thank you. Well, okay, on that part of the question, let's take a step back if you want to talk about pensions. And the issue there is not the re-rating of risk. The issue there is you can't survive at 0 interest rates. Think about it for a minute. If you have, let's say you have a $1,000 annuity, all right? So you ask yourself, well, what's the base have to be to support $1,000 at 10%? Not much, right? What about 1%? 10 times the corpus. So now, I want you to go back over the last 5 years, and if you go back and read the paper, how many companies have ended their pension program? And why? Because they can't afford it. Interest rates are artificially low, and therefore they're saying, I'm not going to pay that because it's going to cost me 10 times as much. How am I going to survive with that kind of a cost? So they end it. They don't care about risk. And the pension fund doesn't care about risk. It can't survive. So my point is, look at the market. This country has a great faith historically in markets until recently. And now we're not willing to rely on markets. So we artificially hold these interest rates down. We artificially do various things, subsidies here, subsidies there, and we're distorting the market, and therefore the outcomes are making us poor as a nation over time, over the long period. And so that's what I worry about more than the repricing. Now, if you take these large institutions, and if you really are doing the risk analysis, you are pricing the heck out of them because they are highly leveraged. And therefore, you know you've got to be alert to that, and you need a premium on that. If you break these institutions out, the market will demand less leverage because their capital's at risk. The public isn't supporting them anymore. And yeah, they may reprice it, but here's how they're going to do it. They're going to demand more capital of that investment bank that's been forced to spin out, just like they once did. I mean, these banks, look at banking in the United States before the safety net held as equity the stuff that we count, the real stuff, the tangible equity. 10 to 13% of their balance sheet was equity. When this crisis occurred, the amount of equity, tangible equity, in those 10 largest institutions was 2.8%. That's less than 3 cents for every dollar of assets. There was no margin of error. So the risk premium, that's why the returns on equity had to be so high, because the risk premium was demanding. Separate this out. You're going to see more capital come into it. You're going to have, I think, a better priced, and you're going to have a less distorted pension market than you have today. We have distorted the market so badly that we're not allocating resources adequately. And the future liabilities that are not being discounted back for this generation is enormous. We talk about how much our debt is, but the future liability is so much larger than that. And unless we start doing that and thinking about that, then we are going to be Spain eventually. Now, we can avoid that. We're a large country. We have enormous resources. We have a very, even today, relative to the rest of the world, a very good market system. But we shouldn't forget that, and we shouldn't allow that to pass by constantly trying to manage to the goal rather than believe in the system that will eventually achieve that goal by not subsidizing the heck out of it. I don't know if I answered your first question or not. I was so long on the second one, I forgot the first one.
The second one you're obviously passionate about, so that's okay. It's about being in an uncertain environment to make decisions on probability of success and
Yeah.
failure.
Oh.
How many more events can happen before the odds of success and failure?
Depends on who you ask. If you ask me, I think the odds on a QE and another quantitative easing exercise is to put greater likelihood of a further misallocation of resources and a greater likelihood of inflation 5 years from now than without it. The benefit, the other odds are that you are going to help stimulate the economy now so that it catches and we grow more quickly. Now, we have the reserves in the commercial banking system have gone from $20 billion to $2 trillion and no effect. So now we're going to put another $40 billion a month in, and it's going to have an effect. It's just illogical to me. And the problem is that stuff in there has to be taken out at some point. And what will be the allocative effects of that? And those are the things that we have to be far more alert on. And well-intentioned, but their uncertainty is today. They're focused. The chairman and you know, I understand it and I respect it. It's focused on unemployment today, but it's like using the wrong tool. You can actually break the thing you're trying to fix as easily as you can fix it using the wrong tool. That's my analogy. So, yes, here. Oh, okay. You're it, I guess, so make it good.
You suggest that the monetary policy will have an effect of 5%. I was always thought that my master's was going to be around a 2-year level. And I don't know of any policy that supports a 4 or 5-year lag on.
You don't? Well, let me give you an example. In 2001 and 2002, we engaged in a quantitative easing. It wasn't called that then, but it was quantitative easing that brought interest rates down to 1% and left them there. That was 2003. 4, 5, 6, 7, 8, 5 years. What happened? So you don't think the fact that we ballooned the balance sheets, we ballooned the leverage with low interest rates had any effect? You think it was fraud? And how many people have gone to jail? Well, that's your opinion. But where are the facts? I mean, no, they leveraged up. They violated underwriting standards, not necessarily violated the law. I mean, that's just a fact. I mean, it's a fact. So, and the incentive was very low interest rates, a subsidy around the insurance program that allowed you to leverage up, lowering of the underwriting standards that allowed you to leverage up and make these loans, and then a collapse. If interest rates had been higher and you could not have marketed this stuff so easily, I doubt that they would have been able to leverage the way they did. Now, that's a 5-year lag, in my opinion. It matters. Now, what you're referring to is the inflationary impact that went on, and Friedman's research in the 60s, when you had a fractional reserve system, said you had long and variable lags, and the average was around 18 months. So long and variable, I think, is the key word. But the reason we didn't have inflation is we tanked the economy because of the leverage before the inflation was able, although we did have inflation in real assets. There's no question about it. So it comes in different forms, in different ways. And like anything else, it's always a group of factors. Low interest rates, poor underwriting standards, a subsidy to an industry, a very high subsidy to an industry, and you get bad outcomes. And I think that's the combination of things brought us this terrible crisis. So thank you all very much. It's been a joy to be with you.